And yes, Eric, we remember a month ago that you told us that you thought we had seen the lows in June, and clearly that was a really good call. But there are still some saying the market's getting ahead of itself on the Fed. We just heard from Michael Rowley of J.P. Morgan, said it doesn't look like the Fed is going to cut anytime soon, and that this is just a bear market rally. What do you think?
Well, yeah. I mean, 2 weeks ago, we kept hearing that, it's just short covering. It's a bear market rally. We haven't seen capitulation yet. That's if I had a nickel for every time I've heard that from someone over the last couple of months. And yet, the market keeps going. And so I think there's another favorite was wait for the E and PE to come down for earnings season. And we're pretty much done, tech earnings at least now. And I think we can just say unequivocally it was a fantastic earnings. Now, part of the reason why stocks have done so well coming out of earnings is because they just were sold off so much in the first half of this year. At some point, price matters, and we don't know when that point comes, but it appears that for some tech stocks it was May 12th, for others it was June 16th, and I believe that those were the bottoms.
Was it a fantastic earnings, or was it just a less bad than feared earnings with a pretty good setup?
I mean, obviously it's case by case. Carvana, basically you had probably a majority of folks thinking that they were going to tip into bankruptcy. Anything that proved that they weren't going straight into bankruptcy was good enough to get the stock rallying and to get to 30% of the float or whatever it was short to start covering. But that stock, I think it bottomed at around $20, and it's up in mid-July, and it's up 150% since. So other names have had stellar earnings, names like an Apple and people like that. Some of the bigger tech stocks, I think, have had solid earnings. So it varies in terms of each individual story on why they've rallied. But the rallies are here. Bad news is being met with rallies, which is obviously much different from the first half of the year.
Well, let's hit Carvana, because you have liked this on the show before. I don't know if you're still in it. And I don't know what your price is, Eric, which matters because, as you noted, it hit 20. It's at 50 now, which looks good, but it was at 315 a year ago. So this has still been a disaster. Yeah,
it dropped something like 75%, and then when people thought the coast was clear, it dropped another 75%. I do own it. I still I own it. I think at $20 it was too cheap. Even at $50 here, it's something that I'm still holding, and I think it can still rally from here because again, there's this sort of specter of bankruptcy hanging over it. And if they can skirt that, they can continue to do well. They've invested in this infrastructure across the country that services used cars today, but they could get into new cars. They could get into fleet management, but they have to prove it. I mean, one of the other things I think I said to you previously, Sarah, is that forget about profitless tech. You really want to think about what stocks might be losing money today, but in a year from now or 2 years from now, they could be major free cash flow gushers. Carvana, the jury is still out. They've never been a free cash flow positive company since they came public 5 or so years ago. But they say they have religion now. They've got commitment to do so. They have a number of insider buys at $20. So we'll have to see. But I'm holding it for now.